Alright guys, welcome back to lesson 2 of the module 1 of the course. So this is going to be a continuation from the previous lesson where we talked about market efficiency paradigm. Alright, so today we're going to continue with institutional reference points, and I will build upon institutional reference points. I have a couple of them which I listed on I think it was the last few minutes of the previous lesson. I listed the different institutional reference points from premium going to discount, and what we're going to do in this video is we're going to select some of them and we're going to explain the idea behind them and why they are the way they are in price. Alright, so hopefully you enjoyed this lesson just like the other one, and let's get going. Alright, so before we go into understanding order blocks and rejection blocks and old highs and old lows and all those different terms, we have to understand what institutional order flow is. Now in price, remember, the candles you are seeing is a reflection of transactions going on in the marketplace. Again, I'm going to repeat this every time so it gets ingrained in your mindset that what you're seeing as candlesticks or what you perceive as candlesticks, they are simply just transactions in price. Now we have institutional order flow, and you can see in this flow chart here we have commerce, we have neutralize, we have manipulate, and then we also have hedge. Now the way this works is commerce is what spurs a transaction in the market. This is what facilitates price delivery. Now you've heard me talk about liquidity base, and I say whenever you see the market in a consolidation, that is what we call stable flows of liquidity or a liquidity base. So now we're going to build upon this topic here. So I'm going to clear all of this up and we're going to do some annotations. This is going to be a very crude diagram of what I'm trying to explain today. So we have a liquidity base here when the market is not expanding, or what you like to call trending. This is what we'll call a liquidity base, and this is defined by stable flows of liquidity. Oh, I spelled this wrong. Alright, so we define this as stable flows of liquidity. That's what a liquidity base is. Now the way institutional order flow works is there is going to be a massive transaction that comes in inside this range, that stable flow of liquidity. It could be a transaction from, let's say, IBM, for example, or it could be a transaction between Bank of England wanting to do business with, let's say, ExxonMobil, for example, right, a large corporation. So we have an influx of large contracts coming to the marketplace. Alright, so a large contract comes into the marketplace inside a stable flow of liquidity, and then this leads to price expansion. What facilitates the entire process of delivery is simply an inflow or an influx of transaction into the marketplace. That is what facilitates transaction. Now remember, as you are trading price, there are lots of corporations who are doing businesses. There are multinationals. There are lots of governments who are doing imports and exports, with the prices being set by what you're seeing on the charts. Now you will notice the market moves from consolidation to expansion back into consolidation. The consolidation are used to build orders, okay, and that's why I call them stable flows of liquidity. So this is what sets the entire process. Inside consolidations is where the elephant is stepping into the pool. Remember the analogy, right, where the elephant steps into the pool, and by the time the entire elephant's in the pool, the water inside the pool is overflowing. That's the same thing here. Inside a range, smart money is stepping in via transactions. Alright, so transactions comes into the marketplace, and then once the market starts to expand, you've missed the move. Now you can wait for the return back into discount and continue into a point of liquidity where the transactions here can be counterparty to, that's what you can wait for. But the entire process of institutional order flow starts with an influx of orders via transactions coming to the marketplace. So that is the first step of the process: commerce, business transaction. And then we go into neutralizing. Neutralizing simply means if we want to deliver prices higher based on the transaction here, then it would be in our best interest to then want to eliminate any buyer inside this range. And that's where we have runs and stops, right? So from transactions, which is what facilitates the entire process and facilitates the delivery into liquidity pools, you're going to have neutralization of pending open float liquidity. So what is pending open float liquidity? Open float liquidity simply is the pre-existing liquidity at any given moment in the marketplace. That is open float liquidity. So they typically are going to rest above old highs and below old lows. Liquidity resting above old highs, we call them buy side liquidity, or BSL, in case you're wondering. Buy side liquidity, or BSL. Alright, and the liquidity resting below old lows, we call them sell side liquidity, or SSL. I'm going to talk more on this when I get to the video where we talk about internal versus external liquidity. Sell side liquidity, or we'll call SSL. Okay, so we have that right there. Now, once we have an influx transaction at this liquidity base, there's going to be, usually not every single time, but there's going to be a neutralization of pre-existing open float before the market starts to expand via algorithmic delivery. Now, the algorithmic delivery, we're not expanding due to buying pressure. That's a misconception. It's not due to buying pressure we're expanding. It's due to artificial pricing in the marketplace. Okay, the market moves artificially due to the interbank aggregator driving prices higher to protect the banks who are offering prices to other clients. So it's simply a protection mechanism that causes the market to create inefficiencies like this. And that's why I call inefficiencies interbank liquidity, which is different from institutional liquidity or institutional sponsorship. Alright, so we have commerce, which facilitates the entire process of price delivery, and then we have neutralization, which eliminates the speculators in the marketplace, so the market can move towards an area where it's going to be counterparty liquidity. And then we have manipulation, and manipulation simply is to provide liquidity into the marketplace. And usually they will do that by, once the market expands out of this, I'm using, again, this is all an analogy. Alright, so they will do something like this, and then they will sell the idea of a short-term high there. Why are they selling the idea of a short-term high right there? Because they want counterparty liquidity to pair up longs here against buy stops. Why? If individuals are shorting this as a double top, or they're shorting the breakout of the short-term low, what is resting above that? That is going to be buy stops, right? If you sell at market execution, your sell stop is a buy order to exit the marketplace at a loss. So meaning, if you shorted the breakout of this short-term low, if the market runs against you, obviously you're going to be wrong in this idea. If the market runs against you, gets your stop right there, you're going to get exit at the marketplace at a buy. So the market is going to buy your order but at a loss, if that makes sense. And that's how you get losses. If you're buying, your stop loss is a market order to sell at a loss. Okay, your take profit when you're selling is a market order to buy at a profit. That's what you're doing. All right, so if they engineer the idea of a short-term high here, and they get individuals or and funds to short this run lower, that creates a pooling of buy-side liquidity. So that means the individuals, either bank traders or long here, they can then pair their long positions against buy side liquidity. So again, the mechanism of delivery here is we have commerce, which starts the entire process, and then we have neutralization of speculators in the marketplace prior to the run higher. This is where you get stop runs. And then you have manipulation, which provides counterproductive liquidity to pre-existing market order flow. Okay, that's how counterparty liquidity is created, and that's why I preach that the market is 100% engineered. Okay, it's not random. None of the things you're seeing in the price is random. It is all engineered. The market at every given moment either engineering liquidity or being counterparty to liquidity. By the way, I'm sipping coffee with black pepper, and it is an awesome combo. I literally invented this combo, so I feel alive. Alright, going back into our diagram. Then we have obviously hedge. And with hedging, this is essentially how the market makers are going to provide liquidity. I'm going to talk about hedging in detail, and this is what will lead us into our order block theory and mitigation block theory, and also old highs, old lows, and rejection blocks. Okay, so I think that's about 4 institutional reference points from the last video. Now, just to explain this diagram in detail, I did a Twitter space today. So I went live on Twitter, and I was doing a live analysis of Eurodollar and Twitter today on the 5-minute time frame. And I was describing that the market should sell off from this bearish value gap, and this is the draw on liquidity for today. Okay, and that was what I was explaining to the guys on Twitter, and they saw it play out live. You can go and watch the recording because it was recorded, and you see me describe exactly what this asset should be doing. Now, the entire premise of this is also the same logic which I'm teaching today. Okay, excuse me, I'm burping a lot because of the black coffee, the black pepper inside the coffee. But now, again, going through the entire process, we have business transactions or commerce inside a stable flow of liquidity, or what we like to call a liquidity base. And our liquidity base is going to stem from this. This is our liquidity base. How is that liquidity base, Jin? Well, if we go to a lower time frame, you're going to see it's a range. Prior to expansion, we had a range here. Now, where is this range occurring at? Above a short-term high. Let's go back. Okay, let's reset all of this. This is occurring above a short-term high. What do you think is resting above a short-term high? Buy stops. Right? Buy stops is resting above a short-term high. So we have commerce, and then we have neutralized together. What's going on here is all the speculators were short on the run lower, and they were selling this run higher, thinking it was a retracement into the range. They're going to have protected stops above the short-term high. So by driving the market up there algorithmically, alright, we're neutralizing pre-existing short sellers in the marketplace and inducing longs in the marketplace. Okay, think about this conceptually. We have induced longs in price. We're going to have their stops below a short-term low, and then ultimately this, because you're buying the breakout. And we've stopped out the shorts in the marketplace because they were selling the rally, and when the market was running lower, they were selling into that. So they're going to have their stops, which is what the textbook teaches. You're supposed to have your stops above the most recent price swing, and that's where you have the stops right there, and the market stops them out. Okay, so what you have here is you have commerce, which starts the entire transaction up here. So you have a building of orders inside of this, and then you have together neutralization of pending or pre-existing shorts, and then you also have manipulation, which provides liquidity. What is a manipulation? Just by the market consolidating here, people are buying this breakout, and that has created a pooling of sell-side liquidity below here. And that's why I told you the drawn liquidity is 1.0670. Now we did not get down into 1.0670. I think the low of this candle was 1.06703. So we're about 3 pipettes short of the target I gave you guys on the tourist space, but still the same play, all right, in price. So by consolidation here, commerce transactions come to the marketplace. So there's going to be market flows or flows of orders or contracts in the marketplace. So want to short euro and long dollar. That's how you get your dollar short. So if you sell euro and you buy dollar, that's how you get your dollar sells. Now the clients or the entities who are doing this, you're not necessarily going in and selling your dollar. Right, they're going in and selling euro, and then the banks are buying dollar against the short euro. That's how it's done in the bank terminal, right? And then individuals who are going along here, due to the manipulation higher, right, that creates a pulling of sell liquidity, and so the market is going to be drawn down there because the institutions or short here, they can only exit this position here if they can find counterparty clients or counterparty participants in the marketplace. That's why the market has to be drawn to these levels. By nature, that is the way the markets are designed. Transactions here, liquidity being created down here by the nature of prices running above the short MI. That's what we have right here. Commerce, neutralize, manipulate, and then hedge, okay, which we're going to talk about on the next slide. And that's where we get into the standard commercial accumulation phase. Now this is going to be vital, and if you can understand this, you would know when the market maker model should present before it happens. You would know when the market maker model should fail before it happens. You would know when an order block should fail before it happens. You would know what constitutes a valid order block. You need to understand this first. Again, remember, it's not important understanding the concept. It's important understanding what's going on behind the concept. That's the goal. So let's talk about the standard commercial accumulation phase. How is liquidity being provided in the marketplace? Why does price move? That's the question. Why is price moving? Because every single run, higher or lower, someone is making money and someone is losing money. Every single time. Someone is making money right now. Someone is losing money right now. At every given moment in price, someone is either making money or losing money. So how does the market move? Why does the market move? Now, if you go back to the previous lesson, and there's a reason why that previous lesson was done, we talked about the storehouse of a currency, which is the central banks. The central banks are the commercial entity for a currency asset. Now, when we get into commodities, there are 3 different types of participants when we talk about commodities. We have commercials, we have large speculators, and then we have small speculators. I'm going to go into this in depth on the higher time frame module, but this is kind of like just an introduction into that idea or concept. All right, so with commodities, we have commercials, and the commercials are the ones who set the prices, right? They're the ones who create the asset. Let's say, for example, cocoa, which is a commodity that is actually traded on the futures contract. A commercial entity for cocoa will be cocoa farmers, which we term as commercial supplier, and then Nestle, which is a company that makes tea and coffee. They will be commercial users, right? And together they are all commercial entities. You're all commercials for that commodity. And then large speculators obviously are going to be small investment banks who are trying to trade cocoa, or smaller funds. There is a let's say there is a, I don't want to say symbiotic relationship. It's not really mutual. It's more of a let's see, what would be the word to describe the separate relationship between the commercials and the large speculators? They both benefit from each other. Now, the goal of the commercial is to set and create the prices for that commodity or for that asset. Now, when we come to Forex, the commercial entity in Forex is the central banks, and they set and create the prices for that specific asset or that specific currency. Now, what creates the liquidity in the price is the relationship between the central banks and the large speculators. How? Due to the provision of liquidity by the central banks to the large speculators. Well, how does that work, Gene? I want to talk about that. When price is declining, the commercials will buy the market. Now remember, the large speculators, when we're talking about the large speculators, we're talking about the funds, okay? So we're talking about the JP Morgan boys and the BlackRock guys, and we're talking about Vanguard, and we're talking about all these large investment firms and large banks, Barclays and not Deutsche Bank. All right, those banks. All right, they are large speculators. They have tons of liquidity and tons of volume in price. So they are trend following by nature. They follow trends because that is the safest way to trade. So they're trend following by nature. So in the downtrend, or what we call bearish order flow, okay, the central banks will provide sell side liquidity to these funds by buying their sell positions. Now let's use this example. If you took a trade right now and you took a trade to sell Eurodollar short by market execution, there are two things your broker is going to do with that trade. Either the broker takes on the risk of your trade to be counterparty to your trade, and that's how your trade gets activated. Right? Every single time you place a trade, someone has to be counterparty to that trade. See, if you're selling your dollar short, what your broker will do is either they pair you against a client who wants to go long on your dollar, or they feed your order into the interbank price feed, or they can take on the risk themselves. But someone has to be counterparty to your execution. Okay, you cannot sell your dollar short and there's no one else counterparty to your execution. Someone has to be counterparty to your execution. That's the same idea going on in the marketplace in reality, behind the scenes, behind all the things you're seeing. The funds need to have a counterparty. Who is the counterparty to the funds? It is the central banks. Because these funds, they're getting priced directly from the central banks. You're not getting priced directly from central banks. You're getting priced from a broker, who's a third party entity getting priced from a liquidity provider. And that's why if you look at brokers and compare them to each other, the open high, low, and close of the high and low of candlesticks usually will vary. Usually open and close will be relatively the same, because that's where we have the bulk of volume in a specific candle. Alright, so as prices declines lower, the commercials will buy to provide sell-side liquidity. So they act as counterparty liquidity to the funds. And this is how you get the provision of sell side. As price declines, commercials buy from the funds. Alright, so commercials in this example, they are at central banks. Okay, so this is what we call market maker hedging program. It is a hedging program. Liquidity is provided in the marketplace by a hedging program from the central banks. Alright, so as price declines, they will accumulate or buy. As price drops down even more, they will stack on and buy more, which facilitates delivery of sell side. As price drops lower, they buy even more. But now remember, every single time price declines and they're buying, their baseline position is increasing, so they are getting increasingly net long. Okay, so they do it gradually, which is what I teach you with price ranges. They come into the marketplace, they'll do it gradually, they'll buy a little bit, and then the market declines, or allow the market to decline, then they'll buy a little bit more, and then the market declines, then they'll buy a little bit more. Then when the market gets into extreme discount, higher time from discount, and they are buying, finally, this is where they're extremely net long. So their books is now extreme net long. Once their books are now extreme net long, order flow shifts to the buy side. Now they have to start providing buy side liquidity to the funds. So what do? As the market starts to rally higher, they mitigate against pre-existing longs. So they sell the pre-existing longs to mitigate position. Right? So as the market goes higher, remember, the funds are trend following. So the funds want to buy. When the market was declining, the funds were shorting, and the central banks were buying from them. As the market rises higher, the funds would then sell against, the central banks would then sell against the funds who are buying. This is how liquidity is provided. And in the process, they also will mitigate pre-existing positions that was used to facilitate order flow. Remember, the number one job of the central banks is to provide liquidity, and then the number two job for them is profit, obviously. So this is your function. What I'm describing, this diagram describes the function of the central banks to price. That's why they are the ones who creates the market. They're the ones who set prices. They are the ones who know where a price is going to turn, where price is going to reverse. They know all these things. So when they're net longing their books, the market starts to shift to the buy side delivery. Then they'll start to mitigate at old accumulation blocks. Right? So what are the accumulation blocks? Bearish order blocks. Why? Institutions will sell in up candle, and that's how you get order blocks. Now this takes us into the definition of what an order block is. Let's go out and then use a data time frame and define what an order block is. So using the idea I just shared with the standard accumulation phase from the commercials. Now obviously if it's distribution phase, you just invert the diagram and it will make sense. So on the left you have distribution block, and then on the right you're going to have accumulation block. Due to the nature of the size of contracts and volume with these entities and these funds, they cannot sell when the market is declining. They don't sell when the market is dropping due to the volume of their transactions. They have to sell when the market is rising. Okay? Why? So as the market is rallying higher, they will short that. They'll short the rally. This is how the institutions get into a position. This is how they build up a position. So as the market is rallying, once the market gets on higher time from premium, in this example we're looking for sells, they will short the rally into that. And then the outcome is going to be the algo declining, price is lower. And declining price is lower. Okay? Now, a lot of times you're not just going to short that last of candle and just leave it at that, right? And you remember, they have huge contract sizes, so they have to build in orders, and that's why they're going to build orders around the high time frame levels, not lower time frame levels, high time frame levels. All right, so they would have to return back, or the algo will return back to what we call the liquidity base. Again, going back into the first example where we have the range prior to expansion, that's called liquidity base. So the algo will return back up into that candle to allow for redistribution. Again, because we're short. Why? Because this candle here was where they previously sold short. If they want to sell short again, they have to wait for the algo to return back into liquidity base, and then they can build in more positions. Remember the elephant in the room analogy, which I use a lot of times. Elephant is walking into a pool in your backyard, and the pool is almost full, and the elephant puts its first foot in the pool, and the water rises a little bit, almost overflowing. And then the elephant puts its second foot in the pool, and then the water rises even more, about to overflow. And then the elephant puts its hind leg in the pool, and then the water starts to overflow. By the time the elephant is completely submerged in the pool, there will be an overflowing of water from the pool, and you're going to see lots of water being wasted. That is the same thing here with the way the institutions get into a move. They have to build in orders, and that's how you get order blocks, right? Order blocks which form around high time frame levels of premium. Okay, those are your high probability order blocks. Why? Because those are order blocks which have institutional support behind them. So once you see an up candle inside an high time frame premium, and then you see displacement, which is the follow through, that is your clue of the footprint of institutional money or smart money right there. And this creates your order block. So an order block is the last bullish candle prior to a decline. This is for a bearish order block, and obviously for a bullish order block you just invert that. So that's a last down candle prior to a run higher. That's a bullish order block. So what you're looking for, you're not shorting the same way just like the institutions up here. Okay, that is way advanced for you right now. What you're shorting is the return back into that order block where they're going to build in more positions. That is where you are going to frame your trading idea. So now let's look at some live price examples there. And we're using bearishness. So we have a short term high up here. Market runs above the short term high. What do you think is going on right there? We are engineering liquidity on the sell side. Why? There's going to be a lot of individuals wanting to go long at the breakout, and that creates a pooling of sell side liquidity below all the short term lows here and the short term low here, and ultimately the parent price swing down here. So as we ran above that, what's going on there? They're selling. What is the evidence that the institutions were selling the rally? This displacement lower. Now if you miss the chance to sell here, which obviously you're not supposed to be doing so because you don't know if it's going to blow through or sell short. If you miss the chance to sell there, you have your bearish order block right there. So what happens? The market goes back up there to redistribute or to build in more of the pre-existing positions up here, and then delivers to sell side, and then delivers to sell side. That's how you get a bearish order block. And then for a bullish order block, just basically the same thing. So if you look for delivery higher, right there, this is the last order block prior to the expansion higher. So if we take out the range, that's an area of sensitivity. Why? We're coming off of an high time frame level. Again, this is a daily level, right? Candle here, market trades down into the 50% of that candle there, sees expansion, trades back down into 50% of the candle, sees expansion. This is a liquidity base. This is where institutions would have built in orders in the marketplace. I'm trying not to make this video long, so I have to make sure in the next couple minutes I finish the video so it's not too long. Alright, so we're back. Here we have a run on buy stop. Market displaces lower after the run on buy stop, and we have a retracement up into bearish order block. You can see trade up there, and then the market runs into discount, small little fair value gap here. If you don't know where fair value gap is, I will do that on a subsequent video, so don't worry. All right. Then returns back up there to reclaimed. So now let's talk about reclaimed auto block. A reclaimed auto block simply is an auto block that has been utilized more than once. Now, when we're using the reference point, typically we like to see sensitivity immediately the market trades into it. All right. So if we're using an auto block, the first time the market trades up into it, want to see sensitivity immediately. But if it goes up into it a second time, that is allowed, and we call that reclaimed. So they're reclaiming a level to build in more positions. That's the idea right there. So this is where you get the idea of a reclaimed auto block, and obviously you can talk about reclaimed breaker blocks, reclaimed mitigation blocks, reclaimed fair value gaps, reclaimed rejection block. The only thing we don't have is a reclaimed old high or low. Alright, but all the other essential reference points, they can be reclaimed. Now let's talk about what a mitigation block is. A mitigation block simply is a failed auto block. That is what a mitigation block is. So what do I mean? If we are assuming, let's see. If we're assuming institution sold short inside this up candle, and we see confirmation with displacement lower, the logical anticipation would be, if our daily bias is correct, and the market trading up into the bearish order block, it has to offer sells. All right, that is the logic behind this. So the market trades up there, it has to sell short. Now, what happens if the market trades through? So, I'll give you an example. So the market trades below the last up candle. That is the wick of that candle, and the wick up here. And then you set your order block for a short. And then the next candle opens up and trades like this and closes above the order block. So we can make this, well, let's do like that. Okay, it's fine. What happens to this order block? Well, this trade through the order block on a closing basis above the body. Again, I'm not interested in the wicks, I'm interested in the body of the candle. This trade through above the body of this last up candle prior to run lower indicates that this is not utilized for shorts. Remember, in up candles around key levels, when you see displacement away from there, use that candle for in the future to sell short if it's at premium. Now obviously if it's at discount, use that to go long. If the market trades through like this, it invalidates this as a level for distribution, and this now becomes inverted as a level for accumulation, and that makes this a mitigation block. So mitigation blocks are simply failed order blocks. Okay, that's what mitigation blocks are. Think about the word mitigation blocks. Mitigate. Right? What are you doing? Mitigation simply means you got something wrong. You're looking to recoup. That's what mitigation means. That's what's going on right here. So market trades through, invalidates this as an area to short because it's no longer valid, since if it was supposed to be valid, it should show a willingness to want to respect this candle as an area for sells, but it's not. So this is not valid for shorts, and then you invert this and it becomes an area to go long. Mitigation block. Going back into this standard commercial accumulation phase, that is literally what's going on here. When the market starts to trade above, it starts to trade through the bearish order blocks, and then they become mitigation blocks. So if you watched the video I did on cable last week, where I described what cable should be doing before it actually happened, and I said this is what cable should do, and this is what cable should do, and cable did exactly that. Alright, this I told you beforehand. If you go and watch the commentary, the evening commentary before all of this happened, I said watch this level for a sell off. Why? this is a mitigation block. Why is it a mitigation block? Well, if our assumption is we're bullish, obviously our assumption was bearish and wanted to see the market trade through. If our assumption was we're bullish and we're using this as a bullish order block, guess what? It fails. This mitigation block fails. The moment you see the market trade through in the closing basis through the body of that mitigation block, it becomes an inversion level. So it becomes an area for distribution. So this is a lower time frame market maker model. See? So this is going to be a market maker or a commercial distribution phase, not a commercial accumulation phase. We're going from shorts to longs. In this example, we're going from longs to short. So you can see we have a range here, then we have another range here, and that is going to be a distribution block. Sorry, an accumulation block. Just like we have, my bad, that's going to be a distribution block. Why is it going to be a distribution block? Because as the market rallies, they sell into the rally. They'll sell into the rally. So in this down candle here, and I'm explaining the concept behind an order block. Inside this down candle here, commercials will sell and institutions will buy. And that the algo will price the market higher, gunning for an high time frame premium and above where there is pre-existing liquidity. Right? So this down candle here, commercials will provide liquidity by selling into the rally. And the funds or the large speculators, they will buy the trend. Again, you're trend following, so you're buying the trend. And the market expands higher. And we have a little bit of a consolidation here, what I call liquidity base. Order comes into the marketplace. Guess what the market does? Expands higher. Down candle here, commercials sell into this again until the market rallies. And then the funds are buying here. Now, this is the caveat to this. The funds, they take lots of losses at market turning points because you're trend following. And this is where the market makers or the central banks, they'll book profits against the funds at turning points like this. Because funds will see stuff like this, they're buying the breakout. While the commercials or the central banks, they're now extreme net short. Because remember, as the market was rallying, they were selling into every rally. They were selling into the rally. And then once the market declines and revisits an area of fair valuation and starts to decline, they will then mitigate. This is an old area of distribution. They will mitigate that position there. So they will buy back their short positions. You're buying it back. The market trades lower, then they're buying back. Do you think this is random that the market is trading back into the open of this order block? Look at this. The open of the order block here of this candle is 1.21059. The high of this candle is 1.21061. So this is off by just 2 pipettes. You think it's random that this is the level of precision that this can turn up into? Of course not, because if you're using this as an order block, you'll be using the body of the candle. Why? Because this candle already traded out into the high of this candle. So if we're going to use this again, and this is something I want to add to your notes, whenever we utilize this most sensitive portion of a bullish order block is the high or the wick of the candle to the 50% of the body of the candle. But usually you want to see the high of the candle and the open of the candle for a bullish order block. For a bearish order block, you want to see the low of the candle and then the open of the candle. For a bullish order block, high and open. Bearish order block, low and open. And then if it trades through the opening price, then you watch for 50% of the body. So that means you take the range of the candlestick body. Why are we using the body? Why are we not using the wicks? That's the question. Reason why is because the wicks are going to vary between brokers, but body is going to remain the same. And body is where the bulk of the volume of transaction is done. That's why we use the body. So you take the body, measure 50% of the range, outlining there, and for that order block to be valid, price was not closed above 50% of the body of an order block. The moment price closes above 50% of the body of an order block, automatically it invalidates that level as an order block. And then you can wait for price to trade through, and then use it as an inversion level for longs if initially you're trying to go short. Okay, and same thing with the bullshit block. The sensitive portion is the high to the open. Then you can allow for the 50% of the body of the bullshit block, and we call that mean threshold. So I'm going to type it out so you understand the term. We call this mean threshold. Okay, that is the 50% of the body of a bullish or bearish order block. Now, because in this example we're looking at this being reclaimed. Why? Because we've traded down here before. If this was to be reclaimed, it should bounce away from the body, but it did not. It traded through. Automatically, it invalidates this as a bullshit block, and it becomes an inversion level, and like that, it's a bullshit block. Remember, go and watch the video I did. I told you exactly what was going to happen and where it should happen before it actually happened. I think it was the video I did on 14th of February. So go and watch the evening commentary from 14th of February, where I was doing my analysis on cable, and I described literally this, everything all the way down to this from lower, and that understanding stemmed from the understanding of this. So that is order block, and that is mitigation block. On the next lesson, we're going to talk more on highs and lows and liquidity pools and open float and all of those different things. That's going to be the next video, and then from that we're going to go into lesson 2. So hopefully this has been insightful, and I hope you enjoyed this. I'll catch you guys all on the next lesson. Be safe.